Hey, what's up, everybody? I'm Tyson Nagasako with Portfolio Planning. We are back for another investment chats with the team from Bridgeport Asset Management. We have John Fisher and we have Ian Hardacre here to walk us through the first half of the year, as well as some of the themes that we're seeing in the investment industry. And they're one of our preferred partners. We really like their management style. We like what they're doing, what they're putting together. So, John, Ian, thank you so much for coming back and doing this.
Hey, Tyson, no problem.
So, it's been quite the year so far. We were just talking a little bit off camera of the pace of life and how fast things are going. It just seems like a go, go, go year. And there's like no off days. Every day you turn around, there's something more to do, something to read, something to be aware of. Ian, what's your take on the first 6 months of this year? How did we do?
Yeah, thanks, Tyson. So I'll start talking mainly about the public markets, and then John will talk about the private markets. But I mean, if we look at the performance of the markets, the North American markets, particularly over the first 6 months of the year, all the markets were in, I'd say, low double digit. The S&P TSX up about 11%, S&P 500 up just over 10 on a total return basis, and NASDAQ up just under 13. So those, I think most people would consider would be normally very good numbers for an annual basis, but that's what we're up over 6 months. So returns have been strong. It didn't come without volatility, though. There was a certain amount of volatility in that, which I can talk about. A few of the events over the first 6 months, obviously the Iran Middle East War was the main one, started February 28th and had a number of effects on the market, mainly on the oil price. So WTI crude oil was about $70 before it started, ran up to $119 by the first week of March, which obviously has a knockoff effect on inflation. So the CPI in the U.S. Consumer Price Index went from 2.5 to 4.5 between January and May. So, and that leads obviously to the discussion from the U.S. Fed about increasing interest rates, where I think 12 or 18 months ago we were talking, or even 12 months ago, talking about decreasing interest rates, which the increasing interest rates is quite interesting, given it's probably, if we continue to have inflation, a necessity, but it's also going against the sort of the will of the U.S. president, who really wants lower rates. So
Yep.
that is obviously the main discussion point in the first two quarters. Throughout that, we saw corporate earnings being quite strong, and ultimately this is what it's about. If corporate earnings keep growing at a reasonable rate, then the stock market should continue to do well. But if some of these events that I'm talking about, including this, start hurting earnings at the high multiple levels that we're at in the market, it could have quite a negative effect, which we haven't seen in a while. The second major issue I would talk about would be tariffs. We don't have enough time to talk all about the tariff announcements that we saw over the last two quarters, including some tariff refunds, etc. But once again, it comes down to the same point: is that we haven't really seen the tariffs materially hit a lot of companies. They have caused some issues, but not on a major basis. So we continue to watch that. And the third point I would talk about, especially with the U.S. markets, is artificial intelligence capital spend. The market has certain points of the market have done quite well because of AI spend. Others not so much. The Magnificent Seven stocks that we've talked about a lot over the last couple of years, which have really driven the market, were mediocre over the first 6 months. Depends on which stock. We had some examples of Google, which are known as Alphabet, had their first negative free cash flow quarter since they went public, which is great. They actually spent more money than they took in, which has never happened as a public company. And if you look at the four large, what we call hyperscalers, Amazon, Meta, Microsoft, and Google, they're projected to spend about $650 billion in CapEx this year. So the debate in the market clearly is this capital going to be spent efficiently? Is it required? What kind of returns are we going to get from this capital? And the jury's out on that. It's very difficult to see right now. What we have seen from that is the knockoff effect on semiconductor companies, semiconductor capital equipment companies, memory companies, etc., which stocks had enormous, some of them, especially memory companies, had enormous runs over the first 6 months because of the high demand and the pricing power that they all of a sudden have. we do own one particular stock that I'll talk about later in the funds. The negative on sort of technology, and we have to remember technology is by far and away the largest part of the S&P 500, is software companies. Enterprise software companies generally have suffered materially with AI because there's the threat that their businesses are going to deteriorate over time, which affects the terminal value of the business. And jury's out on that. And quite honestly, I don't know if we'll know for 3 to 5 years in a lot of these cases whether or not these software companies, businesses have been hurt by AI. So I'd say those are the three main themes. There's many, but in the U.S. market, the S&P TSX had a very similar return, but got there in a very different way over the first 6 months. Q1 was really led by energy because of the rise in oil prices, and materials, mainly gold. Gold has retraced all that gain sort of year to date, but that was a big Q1 performer. Q2 was led mainly by financials. The banks are up on average about 30% year to date at the end of June, which is pretty strong performance when you consider it. Of the S&P TSX, financials are now 35%, with banks being 25% of that. So a quarter of our index is our banks. So if the banks do well, the TSX will generally do well, and the financial stocks did do well in the second quarter. One of the things to watch out for as we go into the second half of the year is USMCA. Hard to predict what's going to happen and how that plays out. It's quite likely it won't be as good for Canada as has been in the past. To talk about the portfolios, we had a number of significant wins in our portfolios. Small mid-cap fund, MGM Resorts International, the largest casino company and gaming company in Las Vegas, received a takeover offer at a significant premium to what it was trading at from one of its board members. That's a work in progress. Jameson Wellness, a vitamin and nutrition company that many people would recognize, had strategic interest in buying the company, and that continues to be a work in progress. In the U.S. fund, our big winner that I mentioned earlier was Applied Materials, the largest semiconductor capital equipment company in the world, was up 180% over the first 2 months, first 2 quarters of the year. The Canadian fund, oil stocks were strong. Cenovus up 53%, Suncor up 27% over the first 2 months. And I will mention we participated in the Apotex IPO, which is the largest one in Canada by far this year. It's done well since Canada's largest generic pharmaceutical company has done quite well since it went public in just recently. And what do we see for the second half? I mean, generally, it's going to be tug of war, no pun intended, between macro factors. The wars that are going on, especially in the Middle East, oil price, which knocks off to oil prices, which knocks off to inflation, as they're all connected, and fourthly, trade policy. Those macro factors will be a big decider on how markets do. And in addition to that, it'd be corporate earnings, because as I mentioned earlier, if corporate earnings are strong and growing, the market should continue to do well. And the other thing to think of, as I mentioned earlier, is just the spend on artificial intelligence, whether there's going to be a return, and what parts of the market can you really benefit in that and take advantage of. And I'll just sum it up to say, I actually am optimistic for the second half. I think corporate earnings have a strong likelihood of continuing to come through. I think it will be volatile, so I think investors should remember that it was pretty volatile over the first 6 months. I think that'll continue in the second half of the year. I look at the growth prospects of the companies we're invested in. I'm really bullish on them, and they trade at significantly lower valuations in the market. So I really like how our portfolios are positioned. I think I'll leave it at that. Maybe pass it over to John.
Yeah, happy to talk about our private asset funds. So there are three of them, as I think most people know. We've got the Bridgeport Alternative Income Fund, which is really a private credit, private income oriented fund that invests in private asset oriented strategies that all generate income. Usually we're generating interest income either through some type of lending strategy, could be private corporate loans, or it could be real estate lending against either residential or commercial real estate. We've got a handful of leasing strategies that are, very unique. We've got a aircraft leasing strategy. So we have an investment in an institutional fund that owns about 60 aircraft that are leased out to airlines around the world. We've also got a rail car leasing fund, which owns about 100,000 rail cars that are leased out to various railway companies and major shippers. And we have some exposure as well to royalty strategies, and that would be either typically music royalties, a little bit of medical product royalties, so medical IP, where we're kind of collecting royalties there from subscriptions, sorry, not subscriptions, prescriptions, and other sort of uses. And we have a little bit of minor exposure to energy related royalties. We've got a private equity fund, which is invested in with all sorts of institutional private equity managers around the world, which is giving the fund's investors exposure to ownership in hundreds of individual private companies, well kind of diversified geographically, globally. And then finally, we've got a private real estate and infrastructure fund, which again, through various global institutional managers, is exposure to ownership interests in all different types of real estate properties around the world, as well as infrastructure assets. So on that side of stuff, it's everything from multi sort of residential real estate, self-storage, retail real estate, triple net lease properties, entertainment related properties. And then on the infrastructure side, it's telecom infrastructure, energy installations, transportation infrastructures, ferries, things of that kind of nature, digital infrastructure. So we're seeing a lot of the same themes that I think Ian talked about in the public markets. Obviously, the economy is the economy, whether you're like investing through a publicly traded investment or a private asset investment, you're still exposed to some type of asset, whether it's ownership in a company or a loan or some other type of asset that we're generating returns from. Things don't really differ there. I'd say what is a little different is how things get valued. I think the private asset market is maybe perhaps taking more of the risks in some cases into consideration. Definitely private asset categories across the board have shown more modest investment performance the last 12 to 24 months. You can see that actually if you look at the published returns from, say, Canada Pension Plan and Ontario Teachers Pension Plan, and some of the larger pension funds out in BC, and other people that are forced to publicly kind of release investment performance by asset category. We were just looking at it, and I think in 2025, Canada Pension Plan was a plus 2% rate of return on their private equity portfolio, so not great relative to public market performance. And Ontario Teachers, I think I'm just going to get the exact number here while we're talking. Ontario Teachers, which has several $billion private equity fund. I'm just looking here, was I think minus 5%. Just getting the exact number here, was minus 5.3% in 2025 on their private equity. So quite different numbers from what we're seeing in public markets. And some of the themes that we're seeing are on the private credit side. There's a lot of concern over vertical market software. It's interesting that the concerns seem to be deeper in private lending around software businesses than in private equity. You'd think it's probably a bigger issue in private equity, but for whatever reason, I don't think it totally makes sense. Maybe there's more retail funds in private credit. It's getting more talked about more, which is, is AI disrupting vertical market software businesses to such an extent that some of these loans that have been extended to vertical market software companies are going to get compromised. But you'd actually think the issue may be more with owning them the loans often come due in 1, 2, 3 years. I think most people would agree the disruption with AI to software companies are software companies going to get either displaced or their pricing on software compromised to such an extent that their profitability is compromised. I would think it's a greater issue being an owner of those companies than a lender. The loans are going to probably come due, and I think they're going to be fine. I don't, there's a lot of discussion on whether the AI disruption in these companies is real. These are pretty sticky customer bases. When I say vertical market software, what that is like you're talking about a very specific type of industry. It could be, asset management like we're in. We actually have a vertical market software company that we buy software from. We pay a monthly fee. And you're paying for them to help us run our asset management business. We're pretty integrated with them, as an example. Like, it's very hard for us to move away. Lots of our kind of data is in there. We get the power of AI, which is amazing, but are we going to leave anytime soon? Are we going to move and like migrate to an upstart? There's a lot of risk in it. So anyway, that's something though that has resulted in both private credit and private equity. They have taken markdowns on the valuations just to be safe. But when you talk to the managers, they actually feel that while maybe the valuations of these businesses have changed because there's a little more risk out there, they still feel the cash flows from the businesses are solid, and they feel that the risk is frankly overdone. But they've seen some of that in public market software businesses, so they're forced to kind of adjust at the same time. On the private credit side, also, we've seen a lot of interest and growth in what we've already been doing, which is allocating to strategies that are a little more sort of niche-y, that are asset-based, things like those leasing strategies, royalty strategies, more specific income-generating strategies are gaining a lot of traction. By and large, people are watching tariffs the same way and how they're impacting businesses. But by and large, I think people are, these managers are seeing the odd problem in their portfolio that they're writing down and taking action with, but we're not seeing broad-based problems yet. The economy is generally pretty good, but it is shifting with tariffs, AI, and other things. On the private equity side, I think what we've seen is a lot less deal activity in the private equity world, which means it's harder to get exits, meaning harder to sell businesses. And then when there's less sales, you get less gains and less valuation increases. And so that's sort of what's driving more modest returns out of the private equity portfolios, which is just less M&A activity, less deal activity. Valuations have settled back a little bit, but a lot of our managers are seeing what they think are really exciting opportunities. The best managers that we're invested with, I think, are still excited about kind of the market, generally performing well, and optimistic about the future. There's a lot of dry powder out there in the private equity world. There's about $2 trillion with a T dollars of uncalled investor capital to invest into private companies. So there's a lot of money waiting to get invested into the private company world, sitting on the sidelines, but usually bodes well for future returns because some of that money is going to exit existing investors from portfolio companies. And then finally, in the real estate and infrastructure sector, I think we're slowly seeing signs of life. Real estate had, a pretty good, call it 20 to almost 25-year run where everyone was making tons of money in virtually any real estate sector, any kind of commercial real estate sector, any residential real estate sector. That kind of paused in the middle of COVID. It first hit office, which obviously things have changed a bit with working from home versus working from office. Retail also was not so compromised now, but people were quite fearful about, online kind of commerce eating into retail real estate, just people ordering things from home versus going to stores. And then finally, probably the biggest factor has just been higher interest rates. Real estate isn't in, people sort of forgot. Real estate's a very interest rate sensitive asset class. And so we've seen a couple of years of very muted rates of return. Again, some of the larger investors in private real estate, the big pension funds, have actually recorded like negative returns. They were generating 10 to 15% a year consistently for like 20 years. And, in the last couple of years, they're showing like 0% return, minus 10, minus 15. But what we're starting to see is green shoots. People are coming out of it. Offices are getting kind of positioned. People are going back to work. I think where we're seeing a lot of interest and activity in manufactured housing, kind of communities, workforce housing, kind of logistics, kind of related real estate, industrial real estate, self-storage, and then infrastructure's generally been a good area as well. It's not really suffered to the same extent as real estate. So I think we're going to see some pretty decent returns there now that we're starting to come out of the dip. I think where investors need to be careful, we see a lot of people heavily allocated to open-ended multi-residential funds, particularly in Canada, and they have also generated stupendous returns. I think where there's a little more risk than people see is just that the valuations on that real estate, there's a huge question mark as to whether they're really being appropriately valued. And real estate multi-residential specifically often gets valued on what's called a cap rate, which is just the property's income over its value or its purchase price if you're buying it. But if it's just, in an existing portfolio, you might say, a property throws off $1 million of income, and we think it's worth $20 million. So like $1 million of income over a $20 million valuation, it's a 5% cap rate or a 5% yield. If you buy the property at $20 million and it gives you $1 million of profit or cash flow every year, you're getting a 5% rate of return before any change in value in the property. And a lot of people feel that some of these properties, maybe the cap rates may be valued way too low. And when you're borrowing money against the properties to buy them, 1% change in that cap rate, so going from a 5% cap rate to a 6% cap rate, if you've borrowed 75% of the money to buy the property, which often people do in multi-residential, you can actually see your equity almost disappear on paper. And that would mean that on paper, you might go from a $10 unit price on a fund to almost zero or a $1 or $2 unit price. And so we'll see how that whole thing plays out, but there's a lot of people talking about that out there, and with some of the larger aggregators of capital in Canada, they've been quite successful on paper. So no shade, but there is a certain math at work there that can be challenging in a rising interest rate environment. But I mean, overall, what I just comment on is there's a place, we still strongly believe there's a place for private assets in client portfolios. When you look back to 2022, S&P 500 lost 20% of its value. Most bond portfolios, because of rising interest rates, it's just how the math works. Interest rates up, bond prices down. Bond portfolios lost 10 to 20% as well, which shocked a lot of investors because they felt, bonds are safe. And they are generally safe if you hold to kind of maturity and you own bonds of solid issuers. But again, sensitive to interest rates, we saw our private equity portfolio was up over 8% in 22. So you sort of contrast that, losses of 10%, 20% plus 8. Every asset category has its day. These are sort of lagging a little right now, but I'm pretty comfortable there'll be a day when these are outperforming public equities. And these things tend to trade leadership positions. It's not to say one is better than the other, but they have a place. And if you're looking to get a smoother rate of return on your overall portfolio, we still strongly believe it makes sense to mix the two inside client portfolios.
Yep, I agree. Great points. We've bumped across some of these Canadian firms that have their own proprietary real estate fund Some of them have been gated this year or in the past year. Some of them have been really written down, some parts written off.
Yeah.
It's not good. Whereas what I really liked about what you said was looking at investing in real estate globally, like you're not concentrated in one area, as well as the altitude in which you're entering, is you're looking at institutional assets, not you're going to go out and buy a warehouse and manage it like it's Bridgeport properties. You're not doing that,
Yeah,
where you're
exactly.
on site running something. I think
Yeah.
that, doing it the way that you do it, it eliminates a lot of that risk of those smaller deals where, it's like having a rental where if you have one rental and you have one vacancy, you have 100% vacancy all of a sudden. That's a lot of
Yeah,
risk.
there's a lot of risk. I mean, we have very large blue chip global managers, folks like Brookfield Asset Management. We're in their $25 billion real estate fund. Starwood in the US, maybe some of your clients might not know the name Starwood, but it's a major global real estate firm with billions and billions of dollars under management, decades of experience. These are not small funds.
Yeah, that's fantastic. And I think there's a lot of security in that, which is really good.
Yeah,
Um, and I really liked your comment on looking at how growing AI is, that one camp says it's going to disrupt the software industry, the SaaS industry, whereas some people they don't know. And I think some of the common commentary that I see out there is people from the tech industry, they don't believe that any one in particular company can go and vibe code their way out of purchasing software from a software company like Salesforce, or like a proprietary market company. Like if you guys had a Bloomberg terminal that's been around for years and years and years, you're not just going to suddenly leave that because created your own on ChatGPT and you don't need to expense that anymore.
yeah,
I don't think that's a reality that we're going to be facing in the near term, but it's something that definitely gets talked about.
sure.
Yeah, no, Tyson, for sure. That's definitely. I mean, I think there's a couple things there. One, as I mentioned earlier, we're not going to know for multiple years really the effect. There are some companies that come to mind that right out of the gate could be affected. I think where the pressure will come, not so much that people will rip out the systems they have, there'll just be more competition. So pricing increases might not be as much, right? Where if you have an installed system that's key to your business, now all of a sudden you have a lot of people calling on you, and you might be able to get lower pricing. So we'll see some of those companies not get the same pricing increases they've had in the past. But as I mentioned before, what's happening really is these companies, a lot of the SaaS software companies, are still putting up very good quarters and very good performance, but the market doesn't care because we all know that it's going to be a little time before we figure out, if they're really affected, which is quite unusual in a way, because usually good short-term performance leads to good stock performance, which is not the case right now with some of those companies.
Right. It's very counterintuitive. Um, you talked a little bit, Ian, about an IPO that was successful that came out this year, and that was the generic brand pharmaceutical company. Can you talk a little bit more about that? Like, how did you guys come into contact with them? When did we add those to the funds, and how did we benefit from it?
Yeah, well, so it's Apotex. It was I believe, about an $8 billion IPO. It's been a company around for a long time. It's been the largest generic pharmaceutical company in Canada for many decades. Was family owned, and then it was owned family and private equity, and then was getting ready to be an IPO this year. It was in hot demand, quite honestly. A lot of investors are interested in it. I mean, Canada itself is lacking pharmaceutical companies, and has a competitive advantage within Canada. Generic drugs, the way they effectively work in Canada, if you're first to market, you get a lot of the market, and you get the pricing, and they're very good at that. And they're selective in the U.S. where they go as well. So, um, and they have the Canadian advantage as well. And I think as we go forward on a political basis, we're going to want our own winners in certain industries, and they'll definitely be one. And the price it became public at, was acceptable. and it's done well out of the gate anyway. So, um, and there's long-term potential. I mean, you think about it, addressable market for generic drug companies is the whole world, right? So, if they execute, they can do well over time.
That's awesome. That's fantastic. About a year and a half ago, John, we were talking about the state of private equity, and we were waiting for the tide to kind of turn so that these companies that have been held private a lot longer can start to IPO, and we were expecting maybe in the next 18 to 24 months to start seeing some of them. I mean, the one that I saw that happened this year that was the big one was SpaceX. But
Yeah.
do you think we're going to see more and more of that evolution of now it's time for some of these private companies to go public or to IPO?
Sure. I mean, I guess I'd say two things. A lot of the exits in private equity, I'd say the vast majority are not IPO, even when the IPO market is doing well. They are either strategic industry competitors buying out a private equity backed company. So, two industry companies coming together, which often yields a phenomenal price because of the synergies involved with putting two businesses together in the same industry. Or, it's sort of one private equity firm saying it's now time for me to exit. I've got investors, including our funds, that want to see a gain, and there may be another private equity firm looking to place capital that also has industry experience, or may play in that size range. So one firm may take a business from, 20 million of operating earnings to 40 million of operating earnings, and that's their specialty in terms of size of company. And then another company, kind of private equity firms, like, we really don't like buying things that are 20 million. We like starting at 40 million of operating earnings. It's a bigger business, and we try to take them from like 40 million to 80 or 100 million. And so it's a very deep market. I think there's something like $5 trillion, give or take, of private equity investment under management now globally. So it's a very large, deep market with all sorts of different players focused on different industries, different size companies, different geographies. So part of it is just, and no one always knows, is maybe people getting more clarity on some of the risks out there, and you start to see deal activity picking up, not necessarily IPO market. On the IPO market, I'd probably let Ian comment a bit more, but my kind of 2 cents worth is that the Canadian market's pretty dead for IPOs, notwithstanding Apotex and maybe a few other things. It's slow, but I think the U.S. market is opening up right now. But Ian, that's sort of more like your area, so I will let you chime in there.
Sure, sure, John. I think that's true. I think in Canada, we haven't seen too many IPOs this year. Like, we had the big one, Apotex, but like even on the smaller scale, we haven't seen as many. I think the funnel in the U.S., though, for the big investment banks, as they say, is quite strong. So there's a lot of companies looking to go public in the U.S. market. Because, I mean, if you're related anywhere around artificial intelligence, there's demand. Space, there's demand. I think defense, there's demand. And for the most part, in Canada, we aren't there in any of those areas, right? For a number of reasons that I could go into another time. So, but there's a lot of technology companies in the U.S. looking to go public. So, which I think is, as John would say, is good for private equity as they get their exit strategy into the public markets.
Yeah. Do you think some of the larger companies, like these mega cap companies, like OpenAI and Anthropic and a few other ones like that, they're kind of in the pipeline and they've been rumored to file their papers to list and to IPO? Do you think that sucks a lot of oxygen out of the markets because of the size of them, or is that just something that we should be looking forward to?
I mean, I don't. I mean, I think it does. I mean, there's only so much capital, and I think there'll be a lot of, if they were to go public in a month, I think there'd be a lot of demand for those companies. So, and it does take capital from other places. There's no question about that. Presumably it takes capital from the 10 large companies or the 7 large companies in the S&P 500. So whether we look forward to it or not depends on your perspective. I don't really think of that way, but there's no question like that capital has to come from somewhere, and it's going to probably come from other public equities.
Gotcha.
Yeah, I mean, it'll be interesting to see whether more traditional businesses and industries have a bit of a resurgence in the next 12, 24 months in terms of investor interest relative to tech and AI kind of related tech, whether there's a flight to, industries and businesses that where AI is opportunity and not threat, and they're already generating solid earnings, and there may be, chances for greater efficiencies, and maybe sort of you could view it as a possible flight to safety if some of the AI investment narrative crumbles. It's hard to say whether that'll happen, but I think it just goes to you don't want to. You definitely want exposure to the AI theme, but you don't want to be all in. It's a risky, it's sort of like anything. Everybody kind of remembers 1999 and '08, a lot of people were all in on kind of financials and overexposed to banks and things like that. And they took a much bigger hit than even the overall market did during those time periods. And I think it was somewhat similar. And I think if I recall 22, when the overall market was down 20% in the US. But if you looked at people that were, overexposed to more NASDAQ type investing and the Magnificent 70, a lot of those portfolios were actually down 30 to 40% if you looked at the Mag 7. And the issue people had, and some managers got caught, is, those stocks are riding high for a long time. Managers got overexposed. They looked at their portfolio at the end of the year. They were down like 30, 40%, very painful. And, the market narrative going into 23, if I recall correctly, I think I got my years right, was very much against those stocks, and owning them felt uncomfortable in January 23. And the whole market talk was reducing exposure to the Mag 7. They're down 30, 40, 50%. And a lot of it was because people had too much exposure. And so they just couldn't take the heat, so to speak. And managers started kind of reducing. But actually, what we saw at the time was we thought those businesses were still good and now we're more properly valued. And we were able to either hold on or increase our positions because we weren't overexposed going into the year. So we weren't facing this, wow, this is like a big bet. We've already lost like 40%. And now do we kind of reduce or not? Like we just weren't so heavily exposed that we could either hold the position because we felt that they were now value oriented stocks, or even increase slightly and pick away. And probably Meta, Facebook was the greatest example of that. It was, I think at the end of 22 or around there, like literally priced to go bankrupt. I think it was trading at, like, Ian can probably remember, like an 8 times PE. Like it was just crazy. Like people thought the business model, they were facing all sorts of antitrust issues and privacy and maybe slowing usage, people thought, and all sorts of issues. And then the stock went up. I think it was at $80 and it's over, where is it now? Close to 600.
Yeah, just under 600.
Yeah. So 3 years later, it's up like, 700%. So again, it just goes to proper portfolio construction and weighing the risks. Risk can always come out of the woodwork. No one was even talking about AI much as a risk to software businesses 24 months ago. And there'll be some other risk. And, you try to stay on top of it, but let's face it, it's pretty hard to do, right? It's like COVID. Very few people were talking about COVID or risk of a pandemic in 2019.
Yeah. I think that really speaks to the reasoning of why you would want to align with professional money management versus do it yourself. Like we talk a lot about bumping up against DIY portfolios. You covered a couple of things. Is like, number one is having proper allocations, which is like your guys' specialty, especially Ian, right? It's having really good companies, but your really good company doesn't have to be 40% of your portfolio. It might be 6% of your portfolio. It's like a piece. And then the other thing that I think you kind of alluded to, which does make a lot of sense, is when these companies do well, how do you take profit? And I think a lot of people get trapped in seeing the chart on their whatever app go up and to the right and they think, why would I sell if it's always going to go up? And they get stuck. We're seeing a little bit right now in Vancouver with our real estate market. People made money in real estate for the past 40 years, and
Yeah.
maybe they should have, cashed in on some of their winnings and redistributed, rebalanced their portfolio, and now they're stuck. No, nothing selling.
Exactly. Yeah,
Yeah,
we saw the same thing here with like real estate. People are just plowing money into it. Big investors, small investors, even sophisticated family offices. We speak to them and we're like, you guys got like 80, 90% of your money tied up in real estate. Like, yes, it's been good to you. Yes, you made your fortune on it, but do you really want to continue taking on all that risk now that you're in your 60s and 70s? You don't want to diversify a little bit just in case?
Right.
Often the answer was no, and I think some of them are now kind of regretting it and trying to get out. But it's not an easy time to do that.
yeah, Tyson, to your point, I mean, it's really a diversity of idea that's important in the public equity funds, right? I think you mentioned DIY investors. I mean, if a lot of cases they own the same idea in 5 different companies, right? And our job is to have diversity of ideas such that they're not as correlated as the market. They're in different businesses. They have different end markets, etc. Right? Opposed to focusing on one sector that's doing well, which leads you to the down 40% one year, and then a lot of investors, and this applies to professional investors too. They look at it and they go, "What happened?" Right? They're down 40% because really, if they had 25 or 30 stocks in the portfolio, 20 of them are really just the same idea, right? So you have to diversify
Yep.
by business, right? But stay. That's how you reduce risk and reduce volatility, and they're not the same thing, but you can do both by diversity of idea.
Yeah. Before we hit record, Ian, we were talking a little bit about like that idea along with the pairing of the human nature aspect of it, where unfortunately you go to, well, I don't go to cocktail parties, but people go to cocktail parties, right? You talk to somebody and then your cousin's going to tell you they got 40% out of their portfolio and they made X amount of percent. And we get a lot of FOMO from the people that are around us thinking that they're doing something better or smarter. And we saw this with marijuana stocks. People would say, I had a lot of trades, guys. I made 1,800% on marijuana way before it actually like became a market. And so it was all speculation. And then once all of the marijuana stocks were legitimate and released and on every platform, that's when everyone else piled in and they didn't make any money. It went to basically zero. What do you advise clients or even other advisors when talking about the human nature aspect of it and trying to combat that and educate them?
Yeah, I mean, as we were discussing earlier, the greed factor is obviously very high now, and the fear factor is very low. But I think, and that's because the market's generally, with the exception of a few days, been straight up since the fall of 22. I think you really just have to understand your investment philosophy, what your goals are in terms of investing, and who you're invested in, what kind of style they have, and there's going to be some years that maybe the returns in a really go market aren't as high. The returns will still be there, and if you're compounding your capital at double digits, maybe you're not getting the 40% years, but you're compounding consistently without the really bad years in there, which really can destroy people's capital. Then that's really what you want. But I think human nature, as you mentioned, is the sort of thing where people look around and they see someone else doing it and then they want it too. But I think with investing, the one thing about investing that I think, especially in stocks, is that returns are a function of risk, right? And I don't think people love the return, but they ignore the risk in certain situations.
Very true. Very true. Um, I'm just kind of having a look at my list of questions and areas that I wanted to cover, but I think we covered quite the gamut this year. I'm really looking forward to kind of what the end part of the year has. And Ian, you touched on it a little bit, but is there anything that maybe we should be watching for, or anything that we should be on our radar going into the second half of the year?
Yeah, I know. I think I mentioned it. I mean, it really comes down to earning. I mean, interest rates obviously play a huge factor in public and private markets. which will be a function of inflation. Do we get an increase in interest rate in the U.S.? How does that affect things? But ultimately, it comes down to companies' profitability, like the market's profitability, and if we continue to have earnings growth, the market should continue to do well. That's the things we should watch for. Really, is really those two things: interest rates, the effect that that has on the market, and whether companies are still growing their earnings.
Fantastic. Before we sign off, John, do you have any final words? Anything you wanted to leave us with?
No, I mean, I think what we'll see on the private asset side is, over the next 6-12 months is we're going to start to see better returns and I think more deal activity, which will ultimately lead to better performance.
Nice. I'm looking forward to that. It's so strange when we started working together and you start reading about it that there's more $100 million companies that choose to remain private than that are publicly listed, and
Yeah.
most people just have no idea. I had no idea. So it is interesting to have that in your portfolio, have exposure to that,
Yeah.
and in a way that, I mean, you can't go out and DIY a portfolio like what you guys put together. It would be quite the feat, and it would, the amount of capital you would require to do that would be nuts.
Yeah, it's great.
So I really appreciate the portfolio that you guys put together. I love the level-headed, properly diversified portfolio, the different areas, and then the different minds of expertise that you guys bring together, and doing these chats. Right, I really appreciate that.
No, thank you. We certainly really appreciate the partnership with you and your firm, and look forward to doing another one of these shortly.
Sounds good. Gentlemen, thank you so much. I'm Tyson with Portfolio Planning. This has been Investment Chats. I will see you guys on the next one.